Harley-Davidson, once the roar of freedom, is now running on fumes. The motorcycle world is booming, but Harley is stuck in reverse, caught in a battle it may not survive. Stay with me until the end, because the outcome could hit your wallet, your choices, and your road ahead. Staring down a cliff. Harley-Davidson was once the roar of American freedom, but the numbers now reveal a harsher truth. The global motorcycle industry is not collapsing, it is actually thriving. In 2024, worldwide motorcycle sales reached more than 61 million units, the highest level ever recorded. Markets in India, Brazil, Turkey, and Mexico surged. Nicaragua's motorcycle sales alone jumped by more than 43% in a single year. Yet while the world is accelerating, Harley-Davidson is stuck in reverse. The problem is not that motorcycles are out of style. It is that Harley has chained itself to the heavyweight cruiser segment, a niche that is shrinking in the United States. Younger riders across Asia, Latin America, and even parts of Europe are buying nimble, inexpensive machines that serve as daily transport. A scooter or 125 cubic centimeter commuter bike makes sense where fuel is costly and roads are crowded. By contrast, a bulky heavyweight cruiser priced like a small car has little appeal in those markets. Even within America, the trend is ominous. Dealers report that more potential buyers come in asking about affordable middleweight options than about iconic big twins. The golden age of the heavy V-twin may not return, and Harley's insistence on defending it makes the cliff closer than ever. And the first jolt that exposed just how fragile the foundation was came from deep inside Harley's own supply chain. 2 weeks of silence. In May of 2022, Harley-Davidson did something almost unthinkable. It halted most vehicle assembly and shipments for 2 full weeks. The company explained the move as a response to a supplier compliance issue. The pause excluded LiveWire, its electric spin-off, but otherwise production lines went quiet. For a manufacturer that depends on steady output to keep dealers stocked, even 14 days of silence was devastating. On the surface, the shutdown ended quickly. But the echoes of that interruption have rattled through Harley's ecosystem for years. Dealers were left short of inventory, and many missed key summer selling weeks. Tier 2 and Tier 3 suppliers, already operating on razor-thin margins, felt the shock as orders dried up. Some never fully recovered, forcing Harley to lean on a narrower and more fragile supplier base. The incident revealed a deeper vulnerability. Harley's just-in-time logistics model looked efficient when sales were steady, but it lacked the resilience needed in an era of regulatory scrutiny and global supply shocks. Even a minor compliance misstep can now ripple across the entire network. The silence of May 2022 was not the disaster itself, it was the stress test. And the stress test proved that Harley's system could buckle with alarming speed. But the problems were not only in factories and warehouses. Out on the street, the customer had changed, and Harley had not. If you're still here, you already know this isn't just another business headline. It's something bigger. So hit that like button to push this story out to more people, and drop a comment with your take. The customer changed. For decades, Harley-Davidson thrived on a mythic image. The bearded rider, leather vest, open highway, and chrome pipes shaking the ground. That image still resonates, but mostly with riders in their 50s, 60s, and 70s. Harley's average buyer today is close to 50 years old, and some analysts argue it is even higher. These legacy riders are aging out of the market. Many are retiring, downsizing, or simply unwilling to handle the weight and risk of an 800-pound cruiser. Younger riders, meanwhile, live in different worlds. They commute through crowded cities, juggle student debt, and worry about climate change. For them, a Harley is not freedom. It is an expensive luxury. A nimble 250 cubic centimeter sport bike or a simple scooter offers practicality. The loud, heavy, and costly Harley does not. Harley's attempts to bridge the gap have stumbled. In 2012, the company introduced smaller entry-level models meant to attract young riders. Sales were disappointing, and the effort was abandoned, reinforcing the idea that Harley could not adapt. Instead of appealing to fresh customers, the brand doubled down on big cruisers for its aging base. The result is a cultural gap. Harley sells nostalgia while the next generation buys mobility. And when that cultural disconnect finally collided with the quarterly financials, the illusion of stability collapsed in full view. Make your bike fit your life. Luggage, lighting, and guards that turn chaos into confidence. Link is in the description. The quarter that broke. The fourth quarter of 2024 was supposed to show Harley-Davidson stabilizing after years of turbulence. Instead, it delivered a brutal reality check. Total revenue plunged by more than 1/3 compared to the year before. The motorcycle division saw sales volumes drop nearly 15%, down to just over 25,600 bikes worldwide. Even Harley's international footprint, once a point of pride, shrank sharply. The guidance for 2025 only deepened the unease. Harley forecast flat to down 5% revenue at its core motorcycle unit, with operating income margins barely 7 to 8%. Its financial services arm, once a reliable profit center, projected a decline of 10 to 15%. The supposed crown jewel, Livewire, was expected to sell only 1,000 to 1,500 units for the entire year, while racking up operating losses of $70 to $80 million. Investors who had hoped for a turnaround instead saw a company locked in retreat. Harley could still generate cash and pay dividends, but the fundamental story, growing riders and expanding relevance, was slipping away. The quarterly numbers stripped away the myth and left only math. And that math pointed to an even bigger storm brewing, one driven not by Harley's mistakes alone, but by the politics of trade and the headwinds of global policy. Tariffs hit hard. A Harley-Davidson motorcycle is not built from Milwaukee steel alone. Behind every gleaming cruiser lies a network of parts, components, and raw materials sourced around the world. That makes the company acutely vulnerable when trade policy shifts. A tariff might look like a line on a government ledger, but in practice, it is a headwind that cuts into every unit shipped. For Harley, the timing could not be worse. Prices for its heavy cruisers are already stretching consumer budgets in an era of higher interest rates. Adding new duties on imported steel, electronics, or finished bikes only magnifies the sticker shock. Tariffs also freeze decision-making. Dealers hesitate to order in bulk if they fear price hikes are coming. Engineers face delays when imported components become uncertain. Even marketing campaigns suffer, since promotional pricing looks risky when supply costs might surge overnight. This is the hidden weight of policy. Not just higher costs, but paralysis. Harley's history shows how vulnerable it is to sudden regulatory shocks. The company has fought tariff battles before, but in a shrinking domestic market, its cushion is thinner than ever. The tariffs may not sound like engines revving, but they hit just as hard, grinding the machine to a crawl. And while policy shocks hit from the outside, a quieter storm was building on the factory floor itself. Labor sees debt. For decades, Harley workers took pride in building machines that symbolized rebellion and power. But pride alone cannot pay rent or mortgages. On the shop floor, employees now face the same inflation pressures as the riders they serve. Wages have not kept pace with costs, and parts shortages have left shifts unpredictable. Instead of steady runs of bikes, teams deal with stop-and-go schedules, sometimes forced to idle while waiting for a missing component. What once felt like craftsmanship now feels like firefighting. The cultural disconnect makes it worse. Management still frames Harley as a family and a legend, but workers see the spreadsheets. They watch debt service eat into budgets while talk of dividends continues. To some employees, the chrome has lost its shine. This tension is not only about morale. Quality can slip when teams are stretched thin or demoralized. Delays multiply, costs rise, and the cycle feeds itself. In an era where a single viral video of a defect can spark outrage, Harley cannot afford the risk. When labor begins to doubt the mission, the foundation of the brand itself trembles. And in Harley's case, the tremor was compounded by a product gamble that was supposed to save the future. That gamble was electric, but the dream came with a very expensive bill. Electric, expensive. The launch of Livewire was pitched as Harley's bold leap into the future. An electric motorcycle carrying the badge of rebellion could have captured a new generation. But instead, it exposed the company's struggle to balance innovation with affordability. Livewire's early models were praised for performance and design, yet their price tags pushed them out of reach for the very riders Harley needed to attract. The results speak clearly. In the fourth quarter of 2024, Harley shipped only 236 electric bikes. Revenue for the division fell by nearly one-third, landing at just $10 million. For all of 2025, the company projected sales of only 1,000 to 1,500 units, while expecting operating losses of $70 to $80 million. The dream has so far been expensive without scale. Competitors have not stood still. Startups and Asian manufacturers are offering stylish, connected electric bikes at commuter-friendly prices. For younger riders, the choice is obvious. Why pay luxury prices for a Harley when a practical alternative is cheaper, smarter, and easier to live with? Livewire has become less a savior and more a cautionary tale. And as electric dreams faltered, Harley turned back to the one lever it still controlled: its balance sheet. Balance sheet product. If Harley-Davidson cannot sell enough motorcycles, it can still sell paper. Harley-Davidson Financial Services, the division that provides loans and packages receivables, has become an essential lifeline. In recent years, the company leaned on securitization deals, turning pools of loans into assets it could sell to investors. These moves unlocked cash, reduced debt loads, and gave Harley breathing space even as retail volumes sagged. In effect, the balance sheet itself became another product. This strategy buys time, but it also carries risks. Financial engineering can polish quarterly results, yet it cannot create new riders. Over-reliance on loan sales ties Harley's fortunes to credit markets, which can shift quickly. Rising interest rates already squeeze consumers. If investors demand higher yields, Harley may face a double bind of weaker loan demand and costlier funding. Still, on Wall Street, the short-term optics look favorable. Share prices can pop on liquidity news, even while showroom floors remain quiet. The paradox is stark. Harley can survive on finance for a while, but survival is not revival. Without growth in its core market, the financial tail cannot wag the industrial dog forever. And that sets the stage for the next arena of conflict, because the battle is no longer confined to spreadsheets. It is playing out in the showrooms and the streets. The dealership winter. In many towns across America, a Harley-Davidson dealership was more than a place to buy a bike. It was a gathering spot, a clubhouse, and sometimes even a local landmark. These showrooms hosted weekend rides, charity events, and late-night meetups. They kept the Harley tribe alive in the real world. But when sales slow and margins shrink, these community hubs are the first casualties. Recent years have seen dealership closures or consolidations that hollow out local motorcycling culture. For a brand built on belonging, the loss is devastating. When a store goes dark, riders lose access to test rides, service, and the rituals that made ownership special. Younger buyers who might have been drawn in by a demo day or a riding class never get the chance. Instead, they turn to other brands or simply never enter the market at all. A closed dealership is not just a lost revenue stream. It is a broken link in the chain of identity. The decline of dealerships is not simply about numbers on a corporate sheet. It is about shrinking the stage where Harley's myth once thrived. And as that stage grows smaller, competitors with more accessible products step in to fill the gap. Because while Harley struggles to keep doors open, other manufacturers are meeting riders where they actually live. Competitors at the door. The truth is blunt. Honda, Yamaha, and other global brands did not have to pry customers from Harley-Davidson. They simply offered products that fit modern lives better. In 2024, Honda alone sold more than 19 million motorcycles worldwide, a staggering lead that shows where volume lives. Many of these machines were small commuter bikes, affordable dual sports, or versatile adventure models. machines built for utility first and image second. For younger riders balancing rent, insurance, and student debt, a reliable 250 cubic centimeter Honda or Yamaha is not just a bike, it is transportation. These brands excel because they make ownership easy. Fuel efficiency, low maintenance, and wide dealer networks create confidence. In contrast, Harley's catalog still leans heavily on heavyweight cruisers that demand high financing costs and specialized service. These rivals don't ask riders to adapt their lifestyles. They adapt their machines to fit riders' lives. Affordable, efficient, and versatile, Honda and Yamaha bikes slip naturally into daily routines. By contrast, Harley demands sacrifice, higher costs, steeper learning curves, and a culture fewer young riders want to inherit. Even Harley's recent ventures into adventure touring with the Pan America or the Rev Max platform have not dented the gap. They are bold steps, but they remain outliers rather than mainstream anchors. The mainstream belongs to the brands that design for everyday mobility. Honda and Yamaha do not need to market rebellion. They sell solutions. And while international giants claim the commuters, Harley faces a sharper challenge closer to home, from a rival that speaks the same language but with fresher grammar. Indian's battlefield. For decades, Indian motorcycles and Harley-Davidson have been locked in a rivalry that defined American cruising. But Indian, now owned by Polaris, has shifted the fight in subtle but powerful ways. While Harley doubled down on tradition, Indian embraced modern design cues, sharper technology, and a broader global push. The result is not an outright victory, but a redefinition of what the American cruiser looks like in the 21st century. Indian sales have not skyrocketed, but they have been steadier than Harley's. In some markets, Indian has even posted growth while Harley shrank. For riders who still want a big V-twin but with a fresher feel, Indian has become the obvious alternative. Its machines carry the weight of heritage, but without looking trapped in time. Younger riders who might laugh off a stereotypical Harley sometimes give Indian a second look. Indian's strategy proves that reinvention can coexist with heritage. By blending modern tech with classic cues, it appeals to riders who crave authenticity without feeling trapped in the past. That balance exposes Harley's weakness. Loyalty alone cannot hold ground when competitors offer both nostalgia and fresh relevance. This shift matters because Harley's strongest defense was its image as the only authentic American cruiser. If Indian can present a cooler, more modern face while preserving roots, Harley loses its monopoly on identity. A war of attrition becomes a battle for relevance, and Indian is quietly redrawing the map. And while rivals shift the battlefield, Harley's biggest challenge remains inside its own books, where affordability and margins are colliding in dangerous ways. Melting middle. The numbers tell the story with brutal clarity. In the fourth quarter of 2024, Harley-Davidson's revenue fell by more than one-third compared to the previous year. Motorcycle shipments dropped nearly 15% to just over 25,000 units. The guidance for 2025 forecasts flat to down 5% revenue in the motorcycle division, with operating income margins stuck between 7 and 8%. The financial services arm expects a 10 to 15% decline in income as higher interest rates choke affordability. This is the math of a melting middle. Harley must rely on premium pricing to maintain margins, but its core buyers are aging, and younger riders cannot afford the cost. Rising loan rates turn what was once aspirational into unattainable. Protecting margins today means sacrificing future market share. It is a vicious loop. Fewer bikes sold, higher prices to cover losses, and even fewer potential customers able to enter. For decades, Harley thrived on volume, but now the math is inverted. Each lost rider pushes prices higher, and each price hike drives away another rider. It is a downward spiral where loyalty cannot offset arithmetic. The middle ground, the balance between affordability and profit, has nearly vanished. In the end, Harley's crisis is not only cultural, it is financial physics. The middle of the market is dissolving, And without new blood, even the strongest brand cannot defy gravity. And that sets the stage for the final act, where the shockwaves spread beyond Harley itself to politics, labor, global markets, and every rider making a choice at the showroom door. Policy roulette. Trade wars do not begin in factories. They end in parking lots. Every tariff, every countermeasure, eventually shows up on the price tag consumers face. Motorcycles are no exception. When governments slap duties on imported metals, electronics, or even finished bikes, the costs travel down the supply chain like a shockwave. Harley-Davidson is exposed, but so are competitors across Europe and Asia. Suddenly, a mid-size bike meant to be affordable feels out of reach. This volatility does not just raise prices, it erases confidence. Dealers hesitate to place large orders when they cannot predict what next quarter's costs will be. Consumers wait on purchases, hoping tariffs will ease. Factories stall expansions because they fear being caught on the wrong side of a trade battle. A tariff is not simply a fee, it is a dice roll with real economic lives at stake. Every tariff swings like a hammer, but the real damage comes from uncertainty. Suppliers hesitate, logistics snarl, and riders watch prices creep higher before committing. What should feel like freedom on two wheels starts to look like another build of fear. Policy roulette isn't abstract, it's painfully personal. For Harley, the danger is multiplied. It already struggles to hold on to customers in a shrinking heavyweight market. Layer in unpredictable price hikes, and the problem compounds. Buyers do not just balk at cost, they lose faith in stability. And once faith goes, loyalty follows. Yet while governments sparred over tariffs, a very different kind of pressure was mounting inside the plants themselves. Shop floor politics. Labor unrest in the broader auto industry has emboldened workers everywhere. Harley-Davidson's employees are no exception. They have watched strikes at automakers yield higher wages, better benefits, and stronger contracts. The lesson is clear. Collective action works. On the shop floor in Wisconsin or Pennsylvania, the whispers grow louder. If Detroit can win, why can't Milwaukee? Rising living costs give urgency to those whispers. Workers face the same grocery bills, rent hikes, and medical expenses as their customers. When they see Harley squeezing profits out of higher-priced bikes while limiting wage growth, resentment deepens. And resentment is dangerous. Low morale does not just sap enthusiasm, it risks quality. A rushed weld, a missed inspection, or a distracted assembly line can seed recalls that tarnish the brand. Harley's workers know their leverage has never been higher. In an era where strikes can halt billion-dollar industries overnight, even whispers of collective action rattle management. Every unresolved grievance, every unpaid hour of overtime becomes fuel. The shop floor isn't just building bikes anymore, it's building pressure. Beyond the factory walls, unions are recalibrating their strategies. Motorcycle production may be smaller than autos, but it carries symbolic weight. A Harley strike would reverberate far beyond its own balance sheet, feeding into debates about American labor power and industrial pride. When labor begins to see rebellion not in the saddle but in the picket line, Harley faces a cultural threat from within. And while workers flexed their leverage, investors were quietly recalculating their patience. Wall Street's Redline. For investors, Harley-Davidson has become less a growth story and more a trading vehicle. Analysts no longer ask how many new riders the company is recruiting. They ask how much cash can be unlocked from Harley-Davidson Financial Services. Recent securitization deals have raised funds and trimmed debt, creating the appearance of resilience. On paper, liquidity looks strong, but liquidity is not the same as momentum. Wall Street's tolerance has limits. Investors want proof of growth, not endless financial engineering. Harley's guidance for 2025, flat to down 5% revenue in motorcycles, 7 to 8% operating margins, and continued losses at Livewire, offers little to excite long-term shareholders. The red line is clear. If the balance sheet keeps carrying the story without the showroom pulling its weight, the stock becomes a sell the rally candidate. For big investors, Harley isn't just another ticker, it's a test of endurance. Patience wears thin when quarterly reports deliver excuses instead of breakthroughs. Every dip in sales, every delayed model, chips away at confidence. Wall Street rewards growth, not nostalgia, and Harley risks becoming yesterday's stock story. Some investors already rotate into broader auto stocks or diversified consumer discretionary plays, leaving Harley exposed to sharper swings. A company once celebrated as a cultural titan now risks being treated as a speculative chip. Wall Street may respect the brand, but it rewards numbers. And as markets judged from above, the consequences landed on the ground, in the wallets of riders deciding whether to buy or walk away. We're almost at the final stretch, but the road ahead only gets more intense. If you've been riding with me this far, don't stop now. Subscribe and turn on notifications. Your wallet, your call. At the end of the day, the future of Harley-Davidson is not decided in boardrooms or policy chambers. It is decided in the choices of individual riders staring at price tags. Higher interest rates turn monthly payments into burdens. Rising insurance premiums and maintenance costs push ownership further out of reach. For a young rider in their 20s, the math often makes a Harley impossible. This is where the company must act. To win new blood, Harley needs more than nostalgia. It must build approachable machines priced for everyday life, not just for affluent hobbyists. Mid-displacement models, urban-focused designs, and credible electric options at commuter-level prices could open doors. Without them, Harley risks being a brand celebrated in museums and documentaries, not on the streets. The decision is also personal. For loyal riders, every purchase now feels like a referendum. Keep supporting the legacy or move to brands that fit modern realities. Consumers are no longer just buyers. They are the final arbiters of whether Harley's myth can survive. And so the road forks. One path keeps Harley roaring as a living legend. The other leaves it parked, polished, and silent, a relic of the past. The story doesn't end here, and neither should you. Harley-Davidson's future is being rewritten right now, and the ripple effects could land in your garage, your wallet, and your life sooner than you think. Don't just watch this play out. Be part of it. Subscribe, hit the bell, and join us, because the next chapter is already unfolding, and you cannot afford to miss it.